As a more dividend-focused, income-focused investor, I've always had an interest in investing into things that can generate high amounts of dividends on a monthly basis. Now, this is of course because I enjoy the cash flow in order to help pay for bills, or of course using the cash flow to reinvest into more dividend-paying stocks or ETFs. Now, some of the ETFs that I use for this strategy are things like JEPI, even the JEPQ ETF, and as of recently, I've even bought a few shares of TSLY, the YieldMax Tesla Income Strategy ETF. But in this video, we're going to go over a brand new untapped income strategy ETF known as QQQY, or the Defiance Nasdaq 100 Enhanced Options Income ETF. Explain exactly how this ETF works and how it's going to generate so much income for investors, or at least it's said to, and see if or if not this ETF is worth investing into. Now stay tuned, drop a like down below, and subscribe for more future content like this. So first things first, heading over to the Defiance ETF's website and looking at the ETF QQQY, it says the first put right ETF using daily options, or ODTE, 1 day till expiration, to seek enhanced income for investors, and best of all, it's paid monthly. Now QQQY aims to achieve consistent and outside monthly yield distributions for investors coupled with equity market exposure to the Nasdaq 100. Now QQQY is an actively managed exchange traded fund, or ETF, that seeks enhanced income constructed of treasuries that are yielding a ton as of right now, and Nasdaq 100 index options. The strategy's objective is to generate outsized monthly distributions by selling option premium on a daily basis. Now, just a side note here, most of the other covered call ETFs or option ETFs in general are using expiration dates a week out, a month out, or even longer, but QQQY is looking at a 1 day till expiration basis. Now, this fund uses daily options to realize rapid time decay by selling in the money puts with ODTE. The fund's investment objective is simple. It's to seek current income, and the fund's secondary investment objective is to seek exposure to the performance of the Nasdaq 100 index, of course subject to limit on potential investment gains. Now, because this ETF just came out literally a matter of a few days ago, I think it's important that we dig a little bit deeper into some of the literature of the ETF to learn exactly how it works. So some of the important takeaways from the literature, it says an investment in the fund is not an investment in the index, nor is the fund an investment in a traditional passively managed index fund. This fund is going to have around a 1% expense ratio because it's so actively managed. If you want to invest into something like VU or SCHD, for example, you're going to pay less than 0.1%, but that's because the fund is much more passively managed. This fund, you are going to have active managers selling puts on a daily basis. It also says the fund strategy will cap its potential gains if the index increases in value. The fund strategy is subject to all potential losses if the index loses value, which may not be offset by the income or the premium received by the fund. Now, this is the important part. It says the fund's use of index option contracts. So each day, the fund will sell at the money or very close to wherever the share price is, and in the money, or a little bit below, puts in the index, or on passively managed ETFs that seek to track the index performance. In particular, the fund will sell puts with near-term expirations at the range of 0% to 5% in the money, i.e. that is where the strike price is above the current value of the index by 0 to 5%. The fund will receive premium income for each put that it's sold. In addition, the fund strategy will provide the fund with the opportunity to earn both time decay, described below, and for in-the-money puts, a limited amount of upside appreciation up to the put strike price, described below also, plus the put's intrinsic value, the expiration date at the time of purchase. For the fund's sold puts will range from 1 day to a week. The fund's participation in the potential increases in value of the index is based on level of the index at the time that the fund sells the put option contract and the index's level of at the money at the time of contract expiration. Now, they even added an example in here. It says, for simplicity, assume the index is trading at $100 at the time the fund sells an in-the-money put with a strike price of 105. If the index level increases to 105 before expiration, the fund will benefit from both increase in the index value up to 105 through the receipt of the premium which was earned through the sale of the option. In addition, the fund would benefit slightly from the in-the-money put extrinsic value. That is, if the fund sold the put for 0.5% of the time value, an amount paid above the put's in the money value for the put's potential increase in value before expiration. Furthermore, if the index level drops below the $100, which was, remember, where it was trading at the time of the trade, at expiration minus an amount equal to the put's time value, the fund would lose money. So if the fund sold an option for 0.5% of the time value, the fund would lose money if the index fell below 95.5. the fund would be obligated to pay the shareholder, and simply put, they would have to basically get assigned the shares. Now, on top of this, the fund is also going to utilize US Treasuries, which are yielding a ton right now, which is also going to generate a lot of income for the fund. Now, the fund will also seek to provide monthly value in the form of cash distribution. The fund will seek to generate income in the following two ways. For one, the US Treasuries, which we talked about, and for two, of course, writing or selling put option contracts on the index described above. So it's honestly a very interesting sort of simple strategy as of right now, but it is going to be much more labor intensive, which is again why I personally think that the 1% is going to be worthwhile. And with this strategy, depending on how the market trades, of course, within a month time frame, this strategy could yield investors around 20 or 30%. Now, another thing I'm sure a lot of you guys are wondering about is, well, what about taxes? How is this fund going to be taxed? Right here it says the fund intends to elect and to qualify each year to be treated as RIC under subchapter M of the code. As a RIC, the fund will not subject to U.S. federal income tax on the portion of its net investment income and net capital gains that it distributes to shareholders, provided that it satisfies certain requirements. Now, if the fund does not qualify for RIC for any taxable year and certain relief provisions are not available, the fund's taxable income will be subject to tax at the fund level and to a further tax at the shareholder level when income is distributed. It then says to comply with the asset diversification test applicable. To a RIC, the fund will attempt to ensure that the value of options it holds is never 25% of the total value of fund assets at the close of any quarter. If the fund's investment options were to exceed 25% of the fund's total assets at the end of a tax quarter, the fund generally would have a grace period to cure such a compliance, and if the fund fails to timely cure, it may no longer be eligible to be treated as a RIC. So it looks like the fund is going to be taxed as a regulated investment company, which is going to be very similar to other ETFs, very similar to this one. So now that we know exactly how the QQQY ETF is going to work as far as strategy goes, do I personally think that this ETF could be worth investing into? Now, of course, because the ETF is brand new, like I said earlier, we don't have any historical performance to go off of. And of course, the ETF has not even paid a single dividend yet. So based off of that, all we have to go off of if we want to invest into something like this is the overall strategy that the ETF has and having hope that the strategy is going to be implemented perfectly. Now, that being said, I am a big fan of selling covered calls as well as selling puts. I think it's a great way for investors to generate more income, and I've been doing so throughout my portfolios for years now. And with what we know as of right now when it comes to this ETF, I personally will be watching it pretty closely and might grab a few shares on some red days. But this ETF's performance and distributions are really going to depend on the volatility in the market and how big the premiums are going to be on the puts that they're selling. Because when there's more volatility in the market, the bigger the premiums are going to be, which means in theory the more income that's going to be generated. But with more volatility also comes more violent swings, which even with this ETF strategy, it could find itself in many different losing trades. But now I want to hear from you guys down below when it comes to the QQQY ETF, the new Nasdaq 100 Enhanced Option Income ETF. Is this ETF that you personally would have in your portfolio? Comment yes or no down below and let us know why. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.